This week on the Wealth and Wisdom podcast, we are unpacking some key shifts in the market and the economy, with hiring and quitting slowing down. Consumer confidence is dipping, and yet the market continues to climb higher. We're also going to break down what these signs of softness mean for your investments, your financial plan, and your stewardship. Plus, we're going to talk about why small cap stocks might actually be the area of opportunity in the market right now in a world obsessed with the large cap tech names and AI, and how faith-based wisdom can guide us when the data is sending us mixed signals.
Yeah, welcome to the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. It's the week of October 6, 2025. We're glad you're here. I'm Brian Cochran, joined by my colleague, Leonida. At John Moore Associates, we're here to help successful and generous families steward their wealth with wisdom and purpose. Each week, we unpack the headlines, the market trends, and the planning ideas shaping your financial world, all through that lens of biblical stewardship. Let's start with what's happening in the economy. Cole, what's going on this week in terms of economic data?
Yeah, well, we only got some of the economic data last week because the government puts out information on a lot of this stuff, and you may have seen a headline or two that the government is officially shut down, which has data implications on when we receive our data. And Brian, I know you're going to get into it as what the implications are for the stock market historically when the government shuts down. But we did get some data from the private sector. The ADP employment data actually showed a loss of 32,000 jobs in September. There was also a downward revision in the ADP jobs numbers for August. That marks 3 out of 4 months of losing jobs on the ADP print. Now, that's not quite the same as the non-farm payrolls number that we generally talk about when we're talking about the labor market. But we did also see the JOLTS data. That's another measure of kind of the labor market as a whole. And it also embedded in there shows the quits rate on how frequently people are quitting their jobs. And oftentimes when we see a higher quits rate, that means that there's some actual strength to the job market because people think they can quit this job and go get another job. And we saw that quits number drop pretty dramatically, which is in alignment with the consumer sentiment data that we got that was falling. It's showing that consumers are not as confident as they were a few months ago, and therefore they're hanging on to those jobs that they have and not going out and looking for market or for jobs out in the market, which we saw, if you remember, coming out of COVID when it was pretty easy to go find jobs. Everybody was trying to hire coming out of that shutdown, and so people were bouncing around. It was almost laughable looking at some of the younger generations. They wouldn't stay at a job more than a year or two because it was so easy to go find another one. And what we're seeing is a cooling in the labor market. We're seeing potentially a loss of jobs depending on which number you're looking at, and therefore those people that have the jobs are maybe a little bit more secure in those. They don't want to leave those jobs because it's a little bit scarier being a job hunter right now. So consumer confidence declining, quits rate is falling, which means that things are softening up a little bit. And we're also seeing a little bit of a softening in the services sector, which has been driving the economy. That's been very positive for a long time now, and that is right at 50. That's on a scale of 0 to 100, 50 is neutral. So we're not growing or contracting, right down the middle on the services side. The manufacturing side, which has been negative, continues to be negative, though if I can say this in a way that makes sense, it is less bad than it was. It's getting less negative. It's inching up towards that 50 mark. So I guess a little bit of good news there on that front. But we get this high frequency data. We get it every month. There's always ebbs and flows and ups and downs. It's kind of zooming out and seeing the trends that are forming. And we've pointed this out the last couple of weeks, really the last couple of months, that it's been notable that the labor market is slowing. It's breaking down a little bit, and that's part of the reason why the Fed is cutting rates. They have the dual mandate that we discussed at length in the investment committee. They want to have stable prices, which is that inflation number, which we know full well that's starting to tick back up. And I say starting, it already is ticking up. It's showing that it's sticky, but they also want full employment, and we've seen unemployment start to tick up a little bit. We're seeing some cracks in the labor market. So as it stands right now, the bond market is pricing in a 90% chance of another rate cut this year. Now we've talked about this the last couple of weeks. The labor market and the inflation are going two different directions. The Fed's kind of in a tough spot right now. And you know what? The stock market doesn't care. This is a bad news is good news and good news is good news situation. The market just continues to plug along. Brian, will you unpack that a little bit? What are we seeing in the market right now?
Well, everything's up. That's the simple answer, Cole. So we had the S&P 500, the NASDAQ, and the Russell 2000 all up over 1% last week. You had gold hitting new highs. You had Bitcoin hitting new highs as of this morning. So everything is moving upwards based on this enthusiasm and overexuberance, maybe, about the future of the economy. I think everyone knows that things are a little slow right now, but there's a lot of optimism ahead, partly because of what you just pointed out, the expectation that the Fed not only has cut rates once, but will continue to cut rates into the new year, and that could be very stimulative to the economy. So there's this one sort of perspective that we see in the markets right now, and that's growth, growth, growth. Things are looking good ahead, and so stock prices reflect that. And what that's done in terms of one of our key things we follow, which is volatility is quite low right now. And I love this image that we share on a regular basis that shows the orange lines here that represent daily moves in the stock market, specifically the S&P 500. So you can see big spikes, such as during the COVID crash. We were double digits in a single day. More recently in the spring, the market got really upset about the news about tariffs, and we saw volatility spike up significantly, including a 9.5% up day, the day the president released news that they were going to delay the tariffs by a few months. So you saw this up and down, very volatile market, but it's really since the spring it's quieted down, and we moved to maybe a complacent market, and maybe now even a very overly optimistic market. Now, one thing we know from this chart and from history is that low volatility we have today will not last. There will be another spike. And I'm not trying to be a prophet here, Cole, but maybe part of that spike, maybe that uncertainty that comes back could be that tension you were talking about, where the Fed gets pulled between cutting rates to help the economy and the unemployment situation versus keeping rates the same or even raising them if inflation comes back and poses some issues in the short term. So time will tell. But there's definitely potential for greater volatility. We've kind of been lulled to sleep with a very easy, good market the last, let's say 3 to 4 months especially. And where that's put us, Cole, is overall the market has reached a level of about 11.5% above its long-term average. So when we think about the market, we often view it not just in terms of how expensive or cheap it looks based on earnings, but also where are we relative to the long-term average. The market has a very strong reversion to the mean, which means that over time, the market may go above its long-term average or below, but it always seems to come back to that 10% a year average it's had for about 100 years. So when we look at the market, we look at where is it relative to the mean, and at 11.5% above as we are today, we would say that's an elevated market, but not a bubble. A bubble would be the tech bubble, which on this chart is kind of on the far left there, where the market was actually 100% above trend. So we're not quite there with the enthusiasm around artificial intelligence and this technology boom we're experiencing. Maybe we get there. Maybe we get to 30, 40, 50% above trend. But right now, not a bubble market, but one that maybe is due for a correction just because of the 11.5% trend paired with the very easy markets of the last few months. So don't get lulled to sleep by that volatility, but also don't be fearful that we're due for a 50% retraction in the market. That would seem excessive at this point. And what's driving this? Again, it's all about the future. We're having a good year this year in terms of corporate performance, but we look at the earnings forecast. That's what really matters. Stock prices are driven by earnings more than anything else. Long-term earnings grow about 7.5%. As of this morning's committee, we're looking at somewhere in the 8% growth rate for earnings here in 2025. What really gets investors excited right now, I think, is if you look at that dot that represents 2026, you're looking at a strong double-digit earnings growth, somewhere between 12 and 14% based on who you ask. And that's a strong number. That's a number that you could get enthusiastic about. So I think what you're seeing today, what you've seen the last few months, is the market is pricing in this growth. And as Cole alluded to earlier, that growth is not just coming from the huge mega companies, the Microsofts and Apples and Amazons and Googles. It's also coming from smaller companies, Some of those small companies actually lost money a year ago and now are moving to profitability, and in some cases, rapidly growing profitability. So they're now helping move this earnings number higher, and therefore their prices are moving higher and helping boost the market. So a diversified investor right now is happy because they've got those big mega companies that everyone's been talking about for the last few years. But if you've had small caps lately, you're very happy and you're starting to see positive earnings and positive price movement. So good earnings acceleration. If you look at the out year, the 2025 is good, 2026 is really good. There's even numbers now starting to look at 2027 that look optimistic as well. So the earnings forecasts are strong. The last thing I would point out is Cole mentioned Fed policy is that tension we talked about that could drive inflation and kind of the tension between unemployment versus inflation. One thing we always follow is money supply and how the Federal Reserve's policy might impact inflation and economic growth. And one of the key numbers to follow is money supply. Here it's listed as M2. It's the top line on this chart. And M2 is basically defined as all the money on deposit and available for people to spend. It's your bank savings, your checking, your money markets, all of those things combined, as well as money market mutual funds. And they really represent liquidity and demand in the marketplace. So when money supply shoots up, like it did during COVID, where it went up unprecedented levels, just explosion in money supply, sometimes that creates too much demand. And that's what we saw at that time. And we all know what happened after that. We saw inflation. But what we've seen also unprecedented the last few years is the Fed actually pulled back the money supply. We saw a decline in the amount of money available to spend. And now, after a short plateau, we're back on the rise, but at a rate slower than what we saw pre-COVID. So before COVID, money supply was growing at just below kind of that 6 to 7% range. Now, not quite that fast. But I don't know if it's enough money supply growth to get the inflation we had, just a few years ago, that kind of 6, 7, maybe even 9% inflation. I don't know if that's the concern. So maybe the Federal Reserve has some space to lower rates because the money supply is muted, but still support the economy with both a slightly increasing money supply and a little bit lower rates. So a lot going on the Fed side, a lot going on the market side, but a lot of it points to positive economy in the new year. The question is just, if it's going to be good, how good might it be? And then what kind of surprises might we see as we get into 2026?
Yeah, that's a really good overview. And I will say that we are back up to just shy of 5% year over year growth on the money supply. We're at 4.8%. So it's starting to ramp back up. Can they smoothly, land on that trend line? That sure seems to be their target. But what the challenge is here is now that money supply is growing again. The idea of inflation is really front of mind for a lot of Americans. We've talked kind of at length in our investment committee about the K-shaped economy, as we're calling it, where we've got the up leg of the K that really benefits from inflation because they're the ones that own assets. They're the ones that have the assets that are going to appreciate, they're going to inflate, and they're not that concerned about the degradation of the value of the dollar or their purchasing power. Whereas the bottom side, the bottom leg of that K, the lower income earners that really are tied to whether or not their wages are keeping up with the level of inflation. That's really a key metric for a lot of Americans, is wage growth keeping up with inflation. And so far, it's been pretty close. There's still been enough for a lot of Americans, at least statistically, though anecdotally, we have heard from a lot of folks that they're really struggling in certain areas. We see that, in some of the message boards online where people are really having a hard time with the price of food and gas and groceries. But we also brought up this week is insurance, things like that, those not monthly charges that pop up where I think one of our advisors said he's been tracking his own personal, and in the last 6 years, his insurance for home and auto has doubled in price in the last 6 years. Now, that is going to impact people, but they don't feel it on the monthly basis, and it can really be startling to people that are, kind of on that edge. They don't have a big surplus. They're not the high income earners. They're making it by, and then all of a sudden they get a renewal on their insurance premium, and it's 30% higher than they were anticipating, that can really wreck somebody's personal finances and can lead to these really high levels of credit card balances that we're seeing. It was pointed out that personal bankruptcies are up 16% year over year. That's a startling number. It doesn't mean that a trend is formed. It just means that right now, at this point in time, on a year over year basis, we're seeing bankruptcies start to go up on the personal side. Historically, that generally leads to, when there's a ramp up in personal bankruptcies, that normally leads to corporate bankruptcies. Not always the case, just a trend, kind of a correlation that we often see. So definitely some concerns, especially for that lower portion of the economy in terms of income earners.
Absolutely. And I think one of the things we were talking about over the weekend, we were sending some data around the team and the stats around the financial pressures of having student loans back on the spending plan, on the cash flow for folks, and the potential impact on their credit, and tension around auto loans. There's just a lot of areas, in addition to what you talked about with bankruptcies, about just that tension you're seeing with low to middle income Americans who are either just feeling some tightness in their spending or are collapsing financially. So hopefully we see some relief on that with either higher wages, more job opportunities, or also the tax reform could benefit some of those families. So time will tell, but it goes back to, like you said, I like how you call it the K-shaped economy, Cole, where some folks are doing really, really well right now, and there's a lot of folks struggling. So that tension will be there in addition to the Fed tension we discussed. Cole, one thing we talked about today too is kind of the history of these government shutdowns. You alluded to it earlier in your intro, but we haven't talked much about the government shutdowns, just because the market hasn't really seemed to care that much. But can you talk a little bit about the stats you shared around, historically in the short term and over the next 12 months, how have government shutdowns impacted the stock market?
Yeah, well, historically, the stock market doesn't seem to mind when the government gets shut down, which we had a Ron Swanson reference in investment committee this morning, that maybe the stock market does better with the government not in its way. But looking at historic numbers, the median shutdown length for the government is 4 days. So it's generally not very long that we're without the government. And that's going back since 1976. The median return over the shutdown, positive 0.1%. It's a short period of time, not a big sample set. But looking at the next 3, 6, and 12 months out after the shutdown is over, we see positive numbers across the board on the average. And looking out at, we're long-term investors looking 12 months out. The 86% of the time, the S&P 500 is positive 12 months after a government shutdown, with the median return being 12.3% for the next 12 months, which is higher than our average. The general stock market average is somewhere around 10% per year. Following a government shutdown, we're getting better than average returns on average. So it is notable because a lot of people look at this as a serious concern, because where the government goes, maybe the economy goes and the market goes. That's not necessarily the sequence of events here. In fact, the stock market traditionally is not really tied to what the government's doing.
Yeah, well said, Cole. And we always talk about separating your politics from your investments. I think a situation like this is sort of the extreme example where those things are not correlated. So yeah, super helpful reminder. And I was a little shocked at those stats, honestly, that over 80% of the time we're positive a year later. I think it just speaks to the resiliency of markets, keeping in mind that the markets are generally positive around 70% of the time in a 12-month period. So it's actually better than the average market to have a shutdown. So back to your Ron Swanson reference, maybe a little shutdown is not the worst thing. But and of course, we hope and pray that we get some resolution on this, not just for the markets, but for the good of our culture and our society. But for any folks who might want to make an investment change related to the government shutdown, that doesn't seem the wise decision at this point.
Yeah, and as I also mentioned in the open, the small cap space could be a place of opportunity moving forward. This is not a big, bold prediction. It's purely looking at what the numbers are telling us. Brian, you had mentioned that we're looking at on the stock market, and we're calling the S&P 500 the stock market just for easy vernacular. We're looking at 12, 13, 14% earnings growth rate going into the next couple of years. Those are really strong numbers. double what we're accustomed to on a historic average on earnings. To put that into perspective, what he means is we're looking at projections of over double the earnings growth on small caps versus large caps. So the large caps are somewhere around that 12, 13% is what the expectations are. In the small cap space, looking at the Russell 2000 index, we're looking at 30+% projected earnings growth rate going into next year. That is bananas. For lack of a better term, that's not a technical financial term, but we're also seeing that we've noticed over the last couple of years that small and mid cap stocks have looked cheap on a valuation perspective. Their price to earnings ratio has looked historically cheap, and perhaps this is a way for that to start coming to pass, where we're going to see they really ramp up in their profitability, which, looking at what the Fed is doing, if we see interest rates cut, that disproportionately benefits these small cap companies because they have to lean on debt to finance their growth and their business operations more so than your big tech companies that have just oodles of cash. And other technical financial terms, so much cash for these big companies, but the small companies need the accessibility to capital, which should be easier to access if we see rate cuts, especially on the short end of the curve.
Absolutely. Yeah, well said, Cole. And yeah, so you take the sector of the market that's already cheaper and you give it faster growth. It's really a powerful combination right now, and the market's starting to recognize that over the last few months, and that may be a strong trend going all the way through into 2026.
Yeah. And so looking at this practically from a portfolio perspective and a planning perspective, we've already identified a potential opportunity in the small cap space, picking and choosing either an index or particular stocks that you might like in that area. That's certainly something that we're keeping in mind as we're selecting stocks for our equity models. But again, this has been a stark reminder to stay diversified because small caps had not been doing well. And now all of a sudden, before you know it, they're outperforming the large caps. We've seen kind of a rotation towards international and now back towards domestic. It's a really strong case. We've seen precious metals do exceptionally well. It's a strong case to stay diversified, to own multiple things all at once because you don't know what tomorrow holds. So this has been a great reminder for us from a portfolio perspective to stay diversified. We also want to make sure that people, when we're looking at the interest rates that we're looking at, what this is going to mean is it's going to mean that we need to be more thoughtful about what we're doing with our cash, because cash is important. It's a risk management tool. It's the primary risk management tool, but where do you find yield for that? We need to be a little bit more thoughtful. It's not just plopping in a money market like it used to be. We need to go look and compare money markets, CDs, treasuries, maybe even municipal bond, depending on where you live. What can you do for those safe assets, the liquidity that you might need? So being thoughtful about that and being really thoughtful about the debt that you have. We have a lot of folks trying to buy homes. What is happening? What's the expectation with interest rates? Well, the expectation, at least on the short end, is that rates should come down, though we're seeing what we call a steepening of the yield curve, meaning the short end, those short-term rates, the 1-2 year rates are dropping, and the longer rates are staying a little bit higher. So the yield curve is getting steeper. What does that mean for mortgage rates? Well, it's not necessarily good news for mortgage rates. We've seen them fall a little bit, and then therefore we've seen mortgage applications spike up a little bit as those rates have fallen, but they're not falling as fast as the short-term rates. So just being thoughtful about the debt you're taking on, the term you're taking on, what risk you're taking on is going to be really important from a planning perspective.
Absolutely. So you captured some of our key takeaways here, Cole. Diversification, always a key takeaway. It seems like every week, but especially right now where you've got small caps surging that may have been left out of portfolios the last few years for some investors. Removing your politics. Government shutdown is not a good thing, but it is not traditionally harmful to markets, so it should not influence your investment decision making. Right? Being wise with debt, as you just said, as well as wise with cash is huge. But one of the overriding things here always, especially as we're in a politically volatile time, is that wise planning beats out the emotional reactions every time, always. We want to be smart. We want to discern. And this is where our value comes in as planners is we're an objective third party that's educated, that's experienced, but mostly is just a good sounding board. You know, sometimes we need wise counsel to stand between us and a big mistake when it comes to finances and other parts of our lives as well. So that's our pleasure to be here to walk alongside families we serve and help them out through these times. It could be a little emotionally volatile, but also confusing when it comes to economics and markets.
We'll wrap there. Thank you all so much for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's episode helpful, please like the video, subscribe to the channel, and share it with someone else who might benefit. And for more timely insights and resources, please visit the Insights page at johnmoore.com, where we share tools to help you steward wisely. We'll look forward to seeing you all next week.